Hello.
Welcome.
To
Timed it. You owe me an IPO.
what's welcome to the Liquidity
Liquidity
event
events.
where your
Host
hosts
AJ. Go ahead. I got you.
I'm AJ
Hey.
and Shane.
Oh shit.
What's up, folks? What's up, folks? How we doing? Happy Friday. It's Wednesday for us, but I like thinking in the future.
Episode number 27 being recorded on January 27th. That's 2022. This says 21. Whoops.
Oh no.
Clickety clack. Clickety clack. 2022. You can still say Happy New Year according to Michela's theory that until you get all of your dates right, you can still say Happy New Year.
You can still say Happy New Year. I agree with that. Where are you? You're in LA still, right?
I'm in La La Land. I'm in Silver Lake.
Good for you.
Having
Good
a
for you.
blast. No, not really. It's gearing up for tax season, so I'm not having a blast. I go for hikes when I can. Work 12-hour days most days. Try to enjoy the weekends when I can. Where are you at?
I'm in my favorite place on earth, which is Palm Springs, California. I just love it here. I'm a lizard. I love the desert. I love modernist architecture. I love large grocery stores with wide aisles, and pools and jacuzzis and.
You like the suburbs, is what you're telling me.
No, it's weird here. It's got a weird energy that I enjoy. Anyways, I've been sitting by the pool reading. I've been reading a book that you gave me called "It Doesn't Have to Be Crazy at Work" by the guys who started Basecamp, and
How's it
it's
going?
fine. It's fine. It's just kind of like your general wisdom of stop having meetings. Basically kill. Don't use Slack. Don't use anything that's distracting. Just tell people what they need to do, and they'll do it, and your organization will be better for it. It's good advice. It's hard to implement.
Don't use Slack, huh? That'll be an update for us.
I don't like that advice.
Is it like a deep work thing?
Yeah.
Like
yeah,
a Cal
it's
Newport deep work?
exactly. It's everything that's not related to work is distracting and wasting time, and that's why we're all working 80-hour work weeks. Is not because there's too much work. It's that we're distracted, and if we just do the work, we'll work less.
I would have to read a whole book on that to be convinced, for sure. A couple books, but down for it. I am reading Designing Your Life by Bill Burnett and Dave Evans, which is cute so far.
Yeah.
Yeah, it's fun. I'm actually journaling a little bit more, seeing a therapist and stuff too. Trying to write more than I read. So
Yeah.
I think that will help with reflection and whatnot. So trying to come up with a resolutions for 2022 that I actually stick to, and trying to be more mindful of it. Back on my pescatarianism and all that. Back on my bullshit. So
Good for you. Good for you. I had shrimp cocktail for lunch. It was great.
that's your that's your insight. That's your input. Okay.
That's my input. No, I'm proud of you for it's the top of the year is always a good time for introspection, and I hope that those habits, good habits with good intentions set in January, if we could all keep them throughout the year, we'd all be better off for it. So that is my wish for you, that you keep up those good habits.
Mine spiral out through tax season and then into the midsummer.
Obviously.
Yeah. What are you doing for fun?
Well, I got a tattoo.
You did get a tattoo. All right.
Did you get a tattoo?
I did get a tattoo. Wow. What are the timing?
No
What a
way.
strange coincidence.
So when Shane and I started Brooklyn FI back, 5 years ago, we made a bet
17,
to
yeah.
each other that if we ever reached a certain monetary milestone, we would get tattoos. Now, Shane has a few tattoos. I have no tattoos. And we hit that milestone this summer, and we were very excited. And it took us until now to get those matching tattoos. It's
because I was in charge of getting it done.
True.
So it took a year.
If you had yes. Anyways, it happened. Shout out to Austin at Silver Lake Tattoo was that place called? American Electric in Silver Lake. It's an Elvish word, Mindora, because we're a big Lord of the Rings fans. So next time you see us, we'll show you our tattoos.
It's AJ's first. Yeah, so cool. I am drinking. I've got two cool things going on. I've got two client gifts here in front of me. Our clients love us so much, AJ. They're so cool. We love them so much. BarkBox went public via SPAC last year, and close friends with someone on the marketing team. They sent me a box full of toys and dog treats. They sent me Doggo Doggo Bills, which is awesome. It's a dollar bill shaped dog toy that Charlie loves. And then I got enough dog treats here for 2022, which is dope. And it's the bark stonks. Stonks.
Oh my God.
Hear that? Anyone whose dog is in the car listening to the rattle of the bag is getting excited now. And I'm also drinking a client gift. Shout out to Meredith for providing Oban, one of my favorite scotches. For
Meredith and Dave. Shout out Meredith and Dave.
I'm sorry. Yes.
Some of our best and favorite clients.
Yes, and shout out to Stacy for the dog toys. Love you guys. I do have to disclose these gifts to the SEC, unfortunately.
Yes, that's true. That's true.
But that's one of my favorite things to do. So cheers.
Speaking of the SEC, we have a financial services company going public.
Yeah. I honestly didn't know where that transition was.
You didn't hear my IPO rocket ship sound effect?
Well, I didn't get the segue. Good segue. Yeah, we have a cool deep dive IPO. It's very close, near and dear to our industry. What is it?
Yeah. This company Dynasty has filed their S1 to go public. And from what I can tell, they are providing services to RIAs, to registered investment advisors. Brooklyn FI is a registered investment advisor, and they are providing a full suite of tools for these registered investment advisors to grow their client base. So in our industry, we would call this a TAMP, which is a turnkey asset management platform.
Yeah.
I was getting there. Give me a second. So essentially, if you want to manage other people's money and you're, let's say, a broker at Fidelity and you no longer want to be at Fidelity, you could break off, you could take your client base and you could set up shop. And a company like Dynasty would help you do that and provide we call it back office services, help you with paperwork, potentially hook you up with some lawyers, potentially help you grow your business, potentially help you sell your business to a larger fish in the future. So it's really a network for advisors to plug into to accelerate their existing investment management businesses. I was sort of shocked by this. I'd never heard of this company. It seems pretty small for a company going public, headquartered in St. Petersburg, Florida. And they've got, 75 employees?
I think less than that. Where do we see this? Oh, no, 75 exactly.
75 employees.
Yeah, I mean, that probably changes on a day-to-day basis for a company that's filed an S1. But then again, this isn't a very large company here in terms of dollar bills. They're doing $46 million in revenue for 2020. That's not great. I mean, what is this going to be? What sector of the market is this company? But Dynasty Financial Partners, super micro cap. They're trying to raise $100 million, which is 2.5 times their annual revenue, which is wild. They've been around since 2010, so they've been around 11 years to get to 42. That number of millions of dollars they service specifically. I guess the reason we haven't heard of this company, they have 50 clients, like not even that many.
Yeah, and 47 firms that they help out.
They have fewer clients than employees.
I like that ratio then.
That is weird.
It's like private school when it's like in public school you have 35 students to one teacher.
Right.
And then in private school you got 10 students to one teacher.
Yeah.
They're the private school of turnkey of TAMPs.
Right. And so they 90% of their revenue comes from managing assets for their clients, which are financial advisors or their clients, and the ultimate client is high net worth and ultra high net worth individuals. So those that have $5 million or more are high net worth, and those with 20 million or more. Not even just net worth, but investable assets like loose change lying around available for advisors to manage for them. So we're talking about not even just 1%ers here, but 0.1%ers in America. And they're taking it public. They're going to raise $100 million. What are they going to use the funds for? I think I read something.
I don't know. I don't think I got that far.
Well, didn't you find a building that they're...
Oh, I did get that. Yeah, they were going to buy a $6.5 million office park in St. Petersburg, Florida. So that's going to be a chunk of the change from the IPO, hopefully. They'll be able to set up their offices and hopefully expand. I'm guessing that's what the $100 million is for.
That's $100,000 per employee. Just some mental math going on there. That's a bit much, during COVID. Don't you feel like commercial real estate is a little bit cheaper than 100K per
Not in
employee?
Florida, I guess.
Not in St. Petersburg?
Yeah, isn't that where the not the Scientologists? Yeah, the Scientologists, big Scientology headquarters in St. Petersburg.
Well, they're profitable. Good for them.
That's all that matters.
Yeah, they're making, they got a double digit profitability ratio here. So if you're looking, for a company that will prosper, if the market continues to enjoy an up and to the right direction, that will help out with companies like this continue to garner the ultra high net worth. One of multiple wealth inequality, income and wealth inequality articles that we have in the deck today. Should we get into articles?
Yeah, I mean, I was just gonna say, I
Uh-huh.
think I had a better segue than you, I think, for this one, which
Ah,
is is that this company is taking most of their revenue comes from they're charging a fee on registered investment advisors based on the size. Now, if the market takes a significant downturn, let's say like a 2008 style recession, their revenue is going to go down because it's tied to the performance of the stock market. Now, we've enjoyed some pretty stellar performance of the stock market over the past decade, but really this week, for the first time since really March of 2020, we saw some pretty crazy volatility. We saw stocks kind of bouncing all over the place, especially some newer tech stocks, some newer IPOs, which leads us into our first article, uh, which is a PitchBook article, which talks about how the stock market sell-off has already taken a toll on pre-IPO valuations. So a lot of companies that were slated to go public in Q1 and in early Q2 of 2022, their valuations we're seeing those decrease a little bit, and we're seeing some people pull IPOs or postpone them. What were some of your takeaways from this article, Shane?
let's see here. One of my favorite quotes, just right off the rip, is that most investors agree that valuations of tech companies should be priced at lower levels in a rising interest rate environment. Like, oh boy. And then now that people understand that the Fed is tightening, that Fed tightening is going to happen, valuation adjustment is happening in a very orderly fashion, Rotman says, much more orderly than people would think. And what we're talking about here is essentially supply and demand. Investors are they demand returns. And in an environment where they have two options, bonds and stocks, traditionally, or ever since the Great Recession, we have the Fed has decreased interest rates to a point where the returns from bond investments are so low that one of the few places that you can find returns necessary on your money to beat inflation and then even increase the value of your wealth through earnings increases and price increases and valuations increases is in the stock market. And now that we're seeing a shift in inflationary pressures, and we got a market that's a little bit hotter than it needs to be, the Fed is working in the other direction by increasing interest rates. All that to say is that now that there are now multiple places to get a return on your investment. You can also buy bonds, and people are shifting into purchasing bonds, which means that money is flowing out of some of the riskier investments. And tech stocks have traditionally been riskier investments with some of the highest prices. So the most expensive things are being sold to buy less risky assets. So not great for our clients, which are tech companies. So their net worth is buoyed by these valuations. This is not a long-term thing, but it is just traditional mechanics, push and pull of the market is being reflected here.
Yeah, kind of just like a practical way to think about it is, over the past couple of years, recovering from the Great Recession, bonds were paying, I'm just going to use a small average of, let's say, 1 to 2% on, a 10-year treasury note or something like that. Now we're seeing 5 or 6%. So if you can get 5 or 6%, why would you want to take that risk by investing in a potentially very volatile startup? So basically people are saying, I'm going to take this risk because 1 to 2% does not get me excited, but 5 to 6%, I'm pretty excited about that. I don't need to take this additional risk is basically what's happening, or what we're starting to see the effects of that happening.
Yeah, it's also interesting that in this, relative to the past, there are a lot fewer public companies. And circling back to my wealth inequality, when I was talking about Dynasty Financial Partners, is that there's so much fewer public companies that investors can participate in the growth of. And most companies are staying, or a lot more companies are staying private longer. and before they have to go public and be subject to SEC regulation and report their earnings every quarter and do things that they don't necessarily want to do thanks to pressure from outside parties. What's interesting about that is that the people that get involved in these private equity deals or dealing with private companies or venture capitalists and private equity firms are all people that are already wealthy. So to participate in the growth of these companies that are going, are staying private much, much longer, and where more and more of that valuation and growth of the value of the company is happening behind quote unquote closed doors for these private investors that already have, extra millions laying around to take risky bets on these private companies. It's just, is that a symptom of our growing wealth inequality? And is that exacerbating the issues where more and more people don't get to participate in this valuation inflation that happens typically in a public space is now happening more behind closed doors? Just a thought, just something.
Right, because the folks who have the, let's say, $50 million chunk to invest, they get to participate, a year before the company goes public, where the hype is all happening. We're seeing a 30 or 40 or even 50x valuation. Company goes public, market pokes a hole in that valuation, and actually the employees don't actually get to benefit from that inflated price. Is what you're saying.
Yeah, pump and dump, kind of. That's what we're seeing. I mean, we're seeing.
To put it briefly.
Yeah, the tech IPO, the performance of IPOs over the past year are subpar compared to the overall stock market. So what we've seen often is that valuations get increase, company goes public, and then the valuation, people buy in, that your standard investor who has access, just to an E-Trade account or a Robinhood account invests, and then the valuations decrease almost immediately after that. So yeah, not a lovely trend for your day-to-day investor.
I've got something that we were going to talk about later, but I think now this is a great time to talk about it.
Sure.
Is this concept of the IPO lockup, and that typically, when a company goes public, those who are significant stakeholders or insiders, typically there's a lockup, meaning they're not allowed to sell their shares until 180 days after the company goes public, because they could be market movers. If you were, let's say, the CTO and you still own 5% of the company, if you want to sell all your shares, you could potentially impact the stock price. You putting all those shares up for sale on the day one of trading could actually sink the stock price. So we have this concept of the lockup. However, we've got some great data from Renaissance Capital that tracked the number of companies that actually basically ignored their lockup. So typically lockups have been in place, and we saw that in 2020 there were 17 companies that kind of did away with that lockup, and they had this thing called an early lockup provision, meaning that insiders were actually able to sell their shares before the lockup went into effect, so right at IPO. So in 2020, we saw 17 companies participating in this kind of backdoor into the ability to be able to sell. And in 2021, guess how many companies didn't give into this lockup, Shane, up from 2020?
I don't know, but I mean, based on the trend of this conversation, I'm assuming more and more early insiders are able to get a quick
91 buck. Up from 17. It's wild. It's basically saying what we basically have learned. It's good to be a rich serial entrepreneur is the theme of today's show, right? In 2019, there were 9 companies that had this. This statistic is shocking to me.
I can't wait. I can't wait.
You can't wait for what?
To be a rich serial entrepreneur.
We're going to look back on the show and be like, ha ha.
One of these days.
Those peasants.
We learned the
little
tricks
did they know.
From the bottom on the way up.
Yeah, anyway, I find this, I love the erosion of the IPO lockup. Our clients are, for the first time ever, able to actually trade. Actually, I was talking to one of our colleagues who runs a firm who's been in the business way longer than we have, right? Who was around in 2001 during that first .com bubble, and he was talking about lockups and how every company has a lockup, and I was like, hold on a second. Actually, with our clients, we're seeing that they're not subject to lockups, and he was like, hold on a second. And I sent him this article, and he was like, holy shit. I didn't know about this data. I assume that all my clients are locked up for at least 180 days. And I was like, there's a new sheriff in town, and that sheriff is allowing you to sell your stock whenever the hell you want. That's what we're seeing here.
Yeah, well, I mean, it seems like a lot of advisors have like 10% of their clients are in the equity compensation space. So what they get exposed to is what they think is the whole industry. So there's a lot of complexity here. Every company is different. Every IPO is different. So it's fun. You got an article here about what to do when stocks behave badly. I mean, we're talking about the market a lot these days. The market is fluctuating in value. We're seeing a drawback in prices. We were in market correction territory yesterday, which means that there was just a big dip in the value of overall stocks. We've got Acorns is also getting involved in individual stock trades. That's retail investor, aka retail investors. And then, this all kind of ties together. Which one do you want to tackle first?
I wanted to just shout out this New York Times article. Our clients are definitely getting a little spooked. We're getting emails saying like, should I be worried? And we're saying for the most part, no, you're invested for the long term. Our portfolios are strategically designed so that we can survive a temporary market dip. But this is kind of a PSA. If you are feeling a little uncertain and you're feeling scared by the fluctuations and you're reading the news, my first piece of advice is to stop reading the news because it's just news. And the financial media likes to be a little doom and gloom. But this piece, the New York Times, kind of walks you through how to kind of evaluate your portfolio and see where you're at. The title is called How to Survive When Stocks Behave Badly. And I liked this quote. It may help to keep that history in mind when you contemplate the recent market storms. If you put $10,000 in the S&P 500 at the start of 1972 and just left it there, you would have more than $1.8 million today. So let compound interest do its thing. This is like a boring old platitude, but I think it's worth revisiting in times like this when it does actually feel pretty scary to watch your portfolio move around that much.
Yeah, yeah. I did put $10,000 into the S&P 500 in 1972, so not sure why I still do this podcast. We also have Acorns, the retail and investment platform. Love Acorns. It was back. This is an old player when it comes to like retail app fintech, right? Like Acorns has been around since 2013, like pre-Robinhood, assuredly. Yeah, the name. I think most of our listeners are familiar with Acorns.
Right, and their business model is they've got this.
Same as Dynasty. It's the same as Dynasty Financial Partners. It's just the other end of the spectrum, right?
Well, I thought their whole thing was that they round up for you, and that you can turn it on so that whenever you make a purchase or whenever you do anything, that the rounding error, that 72 cents or that 13 cents automatically just goes into your investment account. It gets swept into there, so you don't even notice that you're investing. I thought that was their innovation.
That's one of their service models, but that's not their revenue model. That's one of their features is that that's how you get money into the Acorns account. Right. But when it comes to getting paid, they charge you an asset under management fee, just like Dynasty
they're an asset manager.
Yeah, and they charge you. What's interesting is that Acorns charges very high AUM fees, like multiple percentages, like 3%. It's not very much money. Like they might charge you 75 cents on your account, but when it comes to like a percentage of the assets under management, it's very high. But it's because it costs more money to manage all those little accounts. So, our clients don't really care about the bips or the listeners, but like it is interesting. And they're making a Robinhood move, it looks like now, where they're offering the ability to trade individual stocks instead of just the safe and good for investors distributed or diversified index funds and ETFs, eh? They're getting spicy over there. They couldn't resist the temptation.
They couldn't resist the sexiness that comes with bragging to your friends that you picked the right stock and it's up 30% this year. But I found this interesting that they plan to recommend that their users invest 90% of their money in the Acorns offerings, meaning the diversified portfolios with the boring old index funds, and 10% in the individual stocks. This was according to images of the product shared with Investment News, who has this article. So it's sort of like that's generally the advice we give to our clients, right? Is like, let's keep at least 90% of the portfolio. We actually say a little bit higher in our well-diversified portfolio, and you can do whatever you want with the rest. And in this case, they're saying that whatever you want is these individual stocks that I'm sure they'll make some nice, handsome trading fees on as well.
Good for them. Good for I almost said Robinhood. Yeah, well, what else do we have here? We're getting into salt and tax land. We have an article here on, I always love tax arbitrage articles. It's fun to fantasize. As much as you fantasize about buying homes in Los Angeles and you shop on Zillow, I think I fantasize about changing my tax residency. It's just what tax people do, perhaps. And we always do try to experiment with strategies that our clients also explore as well. So anyway, circling back to this, we have an article from CBS News. Reminds me of the article. It's called "Cities in Illinois and Oklahoma Are Latest to Lure Remote Workers with Free Land and Cash." Free land? What is this? The fucking Reconstruction?
Yeah. So I went out to dinner with my aunt and uncle, and they told me about this. That
oh yeah,
they're luring you with these like $10,000 grants. Detroit did this a few years ago.
Yeah.
I think both Italy and Japan do this as well, which is like if you come and settle like an abandoned
$1 house in Italy.
Yeah,
classic.
We'll give it to you. Yeah, all you got to do is put a little bit of money into it and actually live in it, so it's not like an abandoned, scary place.
Yeah, so what we have here is we've got Oklahoma offering you $10,000 to move to Tulsa. I guess Tulsa isn't doing so hot, but with the ability to move fully remote, some people say that there will be 40 million fully remote workers in America within the next 5 years. That's a lot of remote workers. It's like 15% of Americans would be totally remote. They're offering people to revitalize these small towns, different incentives. I think with high enough broadband, like I think it might be time to move to Tulsa, AJ. They're offering me $10,000 to go live until you have to live there for a year. And I've got some fun stats here. I kind of ran the numbers. If you have to live there for a year to get the $10,000. I don't know how mechanically if it works. I don't know if it's taxable, which of course reduces the value.
It's definitely taxable. Come on.
Okay.
How could it not be taxable?
So they say here that the plan is working. Harvard says that people are moving to Tulsa. Harvard did a study on it, and they were able to raise new wages in Tulsa by $62 million. Okay, so that sounds great. There's 62.
Is that a lot?
Well, they're paying $10,000 a head. Okay.
Right.
So I ran some numbers. Oklahoma's income tax rate is 5%. Okay. So if they added 62 million of wages, assuming all of them are in the top tax bracket paying at 5%, that is $3.1 million of additional income tax revenue. Okay. So
which is 1/3 of which is
well,
good,
hold on,
right?
hold on.
Okay.
So you would think, all right, $3.1 million, that's great. Okay, but you're paying $10,000 a head, which means that you need 310 people or less to break even. If you're paying more than 310 people come, then you're not breaking even. You're losing money on the deal. Okay, and to further make it shitty, to make it even shitty, I'm not supposed to curse. They would have to each be making $200,000 or more. So the fewer people come, the less the $10,000 will cost you each time. But each of those people have to be making $200,000 or more. So now the footnote is that that's just 1 year, right? So if they stay for multiple years, then it becomes a better investment from Tulsa. So I imagine that people will stay more. But also I feel like this is probably made up of people that have always wanted to go to Tulsa, or like they have family there anyway, and they're moving home. Like, how many of these people are truly lured by just $10,000 to move to Tulsa, Oklahoma?
Yeah, I don't know. The only thing I know about Tulsa is the horrible race riots that took place in the early 20th century. So I don't know if I'm moving to Tulsa anytime soon.
Yes. Well, yes. That does not leave a good taste in the mouth of the woke millennials that we're already not going to move to Tulsa anyway.
Yeah. No,
so,
thank you.
Anyway, that's fun. I'd rather buy that house in Sicily for $1 than move to Tulsa, but...
Yeah.
Speaking of local taxes, do you have anything else you wanted to?
No, I don't. And we're almost out of time. And there's an article in here that I know you've been dying to talk about for weeks. And I think we should skip to the science and the future section.
James Webb?
Yeah.
Yeah, we've been ignoring the James Webb telescope, and our developer was like, "Why are you guys not wrapped up the James Webb telescope saga yet?" So there's like, all right, fair enough. I'll try to wrap this up. So first of all, did you know our closest galaxy, the Andromeda Galaxy, will eventually collide with the Milky Way, and it'll be called the Milkdromeda Galaxy? Fun fact.
Cool.
A few billion years from now, I'll still be alive. The intent of this telescope, which is rad, James Webb, is to look at galaxies that have been drifting away from us for billions of years, but their light is just now getting to us. So eventually we will not ever be able to reach these telescopes or reach these galaxies, which is dope. And they've existed since the origin of the universe. So it's going to tell us a lot of information about what happened billions of years ago. Anyway, it's up in the Lagrange point. It's orbiting outside the moon. All these gold-plated mirrors that are calibrated to be within 1/1000th of an inch of a hair's split is finally in in effect, and we're going to get some images, our first images from the telescope this summer. So
awesome.
Wrapped up.
Speaking of images, there's an image in the article of the engineering team at not NASA headquarters.
The fist bump? Is that what you're laughing about?
But it's there's a fist bump, but when you think of when I think of NASA, I think of mission control, Houston, the beautiful amphitheater. But this just looks like a room. This looks like our office in WeWork. Just a bunch of guys with double monitors. There's no I feel like the world is so much less glamorous. This team in this room of these 6 people in here, they did the calculations to get this incredible leap forward to understanding our origins, and they're just using the same dull monitors that we are to do our dumb shit.
Yeah, they're in the conference room at the WeWork. Yikes.
Yeah, they're working out of the Industrious outside Baltimore.
Yeah. NASA's really hit a downward slope since the heyday.
Yeah. Yep. Do you have a no-brainer for me this week?
I had one. Use Miro, digital whiteboard.
Yeah,
overvalued.
6 times.
Fuck. No, I don't have one for you.
I don't know. My no-brainer is get out and see the world.
Oh my God. You're going to hit me with the adventuring no-brainer?
No, not the adventuring. Just I don't know, go outside. I've been not following my doctor's advice, your advice.
You're such a freak. Your advice is to go outside because you did it for the first time in a year.
I went on a hike and it was so nice.
Oh my gosh. Says so much about you.
I think that's a show, folks.
All right.
You want to read us out?
Yeah, sure. I hit it. Email us at liquidityevent@brooklynfi.com. Leave us a voicemail and we'll play it on the air, podinbox.com/liquidityevent. Show notes can be found at brooklynfi.com/episode 27. And those BKFI stands out there can leave us a review if you want to be weird about it. Thanks, everyone.
See you next week.